everyone. Native Trader here with a after action report for Friday, November the 8th. Today's lesson is going to be on how to trade under the 200 moving average. If you look at my chart, I have two indicators. I mostly only have two indicators. Sometimes I'll add a third one, but it's always going to be two. And that is the red line, which is a 200 moving average, and the blue line, which is the 20 moving average. I find that having a clean, concise chart allows for proper technical analysis and also gives you, the trader, a better visual as to where price action is and where it is going. That being said, the 200 moving average, regardless of the financial instrument, regardless if it's a stock, forex, cryptocurrency, the futures market, whatever, the 200 moving average is the granddaddy of all moving averages. To quote a famous movie, it is the one ring to rule them all. So keep that in mind as a trader. You should always have the 200 moving average on your chart and also the 20, because I find that price respects those two moving averages a lot. And so, with that being said, let's get into this. A lot of people are always curious, or they want to know how to trade or how to short a position and where they should do it. And I say under the 200 is where the most ideal shorts will come from. A lot of people are good at long positions, but not so many are good at short positions. And remember, what goes up must come down. There are going to be retracements. There are times when the financial instrument will be under its 200 moving average, and also its 20 moving average. And these are the times to strike. This is when you as a trader can be profitable as a short seller. So let's get right into it, okay? What we have here is the 15-minute chart. More importantly, if we look at this chart, we see that we have price attempted to break up to the 200 after being down for a while. And what happened? It got rejected. Got rejected right here. The moment that this candle gets rejected by this red bar, the moment this red removes this green right there, that's your entry. Bam, right there. You're in for two lots, okay? That's your entry position right there. Now, where does the stop go? The stop goes one bar up. Top of this wick right there. That's your stop. And if we connect this from there to there and here, this box right here, this box right there is your risk. Does everyone see that? That's your risk. This box. Now I ask you, what is the next step after we're in? Well, we wait. We wait for the retracement up, 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 and the moment that this green bar gets eliminated here, bam, we strike for one more. One more. Bam. Now we're in for three lots, okay? And look at the price action here. Look what that does. I ask you, how many of these boxes can fit into here? 4? 5? A 5-to-1 trade? 4-to-1 trade? That is a great trade to be in. That trade would have made your week on the Nikkei. It's trades like this that you have to be aware of because they present themselves quite often. This happens to be on the 15-minute chart, but you can easily find them on the 5-minute, the 2-minute, the hour. Whatever you trade, setups like this will inevitably come to you. You just have to be patient And knowing when and where to strike is the key to all of this. Look for red bars that eliminate green bars below the 200 and near a key moving average. Okay, that's the big caveat, near. This right here is near the 200. This rejection here, somewhat near the 200, very close to the 20. Key moving average. The rest is history. So let's find another trade today. Let's say I don't trade the Nikkei. Maybe I trade oil. Aha! Look at this. We have another one. This is the micro crude oil. Again, 15-minute chart. I like the 15-minute chart because it is the battle time frame for the day trader. Another time frame that you may want to consider if you like to get into day trading, or if you are into day trading, the 5-minute and also the 2-minute. The 2 minutes has its pros and cons simply because at the 2-minute level, there's a lot of wrinkles up and down that often fake traders out into thinking they're bigger moves than they really are. The higher the time frame is, two things are going to happen. One, you may not get as many chances as you would on a smaller time frame. So, for example, on the 15-minute chart, you may not get as many setups on the 5 or the 2. However, when the moves do come, they're typically bigger. So therefore, your reward, your profit, is often going to be substantially bigger than it would be off of a 5 and 2-minute. Generally speaking here, okay? Let's look at micro crude oil. Again, what do we have here? Well, we have major setup that I like to see would be right here. This red bar right here. Red bar. Let's make that a little bit better, shall we? This red bar. Bam. 2. Stop. Here. If you wanted, you could add the moment that this green bar gets eliminated by the red. Add 1. Okay? Ride this down. Would have probably gotten out here. Got rid of my 2 shares here. Rotate my stop from right here. Rotate it to break even. This is my new stop now. Break even's always going to be where your stop is when you take profit. Okay? And then maybe I would have gone out down here because, as you can see, at this point below here, we're kind of extended from the 20 and also the 200. See, price can get away from the 20, but it always goes to the 20. Goes away from the 20, gets back to the 20. Goes away from the 20, comes back to the 20. We have other trades that we'll get into right here, but for now I'm going to start with this one. This is how I would have done this one. Out right here, out completely. Bam. Profitable there. Okay, well, let's just say I missed that. Maybe you had something to do. Maybe you weren't even awake. Futures market trades 23 hours a day, so it's impossible to get every price action movement because, quite frankly, you may be asleep when price action occurs at key moments in the futures market. But there are times in the morning when you may not be asleep. You may be wide awake. In the morning here, well, what do we have here? As you can see, as we've trailed down from the 20, we come back up and we get rejected. Price gets rejected on this candle here. Here is your 200. This is coming very close off of the 200 and through here. If I were to take this trade, I would have waited for this position here, that green, to be eliminated with this red, and then I would have hit right there. Bam. 2. Stop. Stop's going to be either above the wick of the red or at the 200 itself, right in there. Somewhere right in that zone right there would be where I would have placed my stop. 1 bar, okay? Then, what I would have done is I would have waited. Waited. It does retrace. Yes, it does retrace, but does it go past our stop here? No, it does not. And the moment that this bar, this green bar, gets eliminated by this red bar right there, I'm in for another one. And as you can see, the price dips. I would have probably got now right here at this one, okay? But let's say you did not, and you waited and actually got out here, even better, okay? What's next? After we take profit from our position, we always rotate our stop to the last break even spot. Where's break even in this case? Break even is going to be right down here. This is the new break even spot right here. It's where we added, and this is our last break even. Price comes up here. I would have probably gotten out as it retraced back down to here, gotten more profit. I would have gotten out right there. 1. And that's how you trade under the 200. It all starts by being patient, waiting for the right play to come to you, waiting for the right moment in time, okay? Even this one right here. Let's say you missed all of this. Let's say, for whatever reason you had a late break in the day, you couldn't get out of bed, whatever. You have this removal right here, off the 20. This little guy right here. Bam. Maybe you're in for 2 right there. That's a great entry too. Look at this. I mean, it's not as big as the other movements, but you know what? You're still profitable down here. I would have gone out here. Because we're starting to separate from the 20 and the 200. And that's a good time right here to be out of the trade. Not in for that long. Maybe this is a 45-minute trade. It's not bad. That's how you stay profitable. This is how you stay profitable as a short seller. Okay? You have to wait for the right moment to appear. You can't just be throwing darts at things. You have to wait. A good place to wait would have been right here. Under there. Okay? Send it in there. Okay? 2. Get out here. Okay? Send it in here. 2. Get out here. All under the 200. Below the 20. Those are the key elements. That's the big takeaway from today. If you're going to short under the 200 and short when it is either below the 20 or when you have something that's powerful enough off the 200 that's coming through the 20. Anything else? Avoid it. You might be playing the trap zone. So keep that in mind. And with that, I'm Native Day Trader. Thank you for watching. If you found any of this to be helpful, please like and subscribe. Leave a comment below. Until next time, keep trading.